James, thank you for joining us. Here we are at the start of July. Looking back then, how did the Harmony portfolios fare last month?
Well, June was quite a lot like May in one sense, because we had a month where there wasn't a huge amount of news around. There were no sort of big surprises up or down, but the markets actually went up quite nicely. We had a decent return from the global equity markets, just shy of 2%. Fixed income also providing a positive return as well. So you had another one of these months where there wasn't a huge amount of news around. Central banks continued to print money, and arguably that influence more than anything else is keeping these markets drifting up.
Gradual rise, most markets going up.
Yeah, exactly. So there is a differential here this month where we didn't have last month. There was a very significant regional differential because you had a couple of markets, particularly the UK and Europe, where we had negative returns from the local equity markets, whereas the likes of the US and Asia had positive returns. So you're roughly split down the middle in the Harmony Fund range. Of the 8, you've got 2 pairs in the US and Asia that made positive returns, and then the funds investing in the UK, in Europe, and in Australia, in low negative returns over the 1 month.
Yeah.
Over longer time periods, 3 months, 6 months, 12 months, and out, over longer time periods as well, you've got positive returns across the board. But again, over the short term, this real bifurcation in a world where markets went up generally. You've got this bifurcation in these markets where you had poor, lowish negative total returns,
Yep.
And you've got the others who generated, reasonable positive total returns.
You've touched on it there, obviously being a reasonably quiet month, similar in many ways to May. At the same time, what were the main themes that were coming out for investors?
Well, on a political front, you think I'm mad for saying it was a quiet month. We had ISIS, who are the Iraqi faction, if you like, and Syrian faction, took over vast swathes of Iraq in pretty short order at the start of the month. The speed of that progress was remarkable, and it did unsettle the markets over the short term. I think the important thing to bear in mind there, whilst you don't want to belittle the sort of humanitarian side of it, from a purely investment point of view, Iraq is a relatively small part of the global investable index. Is very small, in fact. Likewise, the bond market as well. So in terms of portfolio impact, the primary impact, the direct impact, is very small indeed. You can get secondary impacts from these events. Clearly, similar asset classes, Middle Eastern equity, emerging market equity, other sort of risk assets might have sold off in sympathy, and they did initially. But I think as ISIS's progress slowed, we saw they weren't going to easily penetrate down into the south, which is where all the oil fields are. They weren't going to be able to take Baghdad easily. I think people started to become a bit more relaxed about it. So, the immediate consequences of portfolios is modest. There is a risk, obviously, of contagion or spread of these kind of unsettling events throughout the region, but that's largely an unpredictable event. It's not something that we would have confidence predicting as investors, as opposed to sort of political analysts, I suppose. And so it's not something one would want to try and bake in a strategy to the portfolio to try and either make profit out of or to try and protect against too aggressively, because it is a largely unpredictable event. So that's one of the main themes. It caused a bit of unsettlement at the start of the month, but investors relaxed as the month progressed. The other is quite a newsworthy event really as well, just goes to show the kind of scale of things we see on a monthly basis these days to sort of lead us to underplay this, is the European Central Bank, largely in a manner consistent with their guidance in the market, putting negative interest rates in place on excess capital left at the ECB by banks. And that's a pretty clear signal from the ECB to the banks saying, go out and lend, stop holding money, do whatever you can to stimulate the economy. Now, interestingly, there's not a huge amount of excess reserves at the ECB anyway, so it's not going to make a massive difference, I suspect. But it's a very clear sort of signal being made to the banking sector there. And then you've got the targeted LTROs as well, which is a sort of a cheap financing operation provided by Europe, consistent with the LTRO, which we've seen in the past, but again, clearly on a sort of more targeted basis. So they're the two main themes in the markets, and clearly, important themes, but in the context of what we've seen over the last couple of years, relatively modest in terms of their impact.
Still relatively quiet. To draw you on those points just quickly, James, I mean, you're sat here in London, you're managing clients' money. Should you be trying to predict things like ISIS? Should you, I don't know, whatever you can do to get local assets maybe there to think about, these things happening?
we are valuation-driven investors, and
Yeah.
there's certain elements of that you can predict with some degree of certainty, at least because you expect reversion to a normal level. So things like earnings and what that means in terms of profitability for businesses and how that converts into a price multiple over the long term. It gives us an idea of what we think you could reasonably expect from equity markets over, let's say, a 5-year time horizon. And what's more, we try and reduce our sensitivity to any one scenario by thinking about the world in a variety of scenarios. We think we invest for the base case, but we bear in mind a slightly more bearish case and a slightly more bullish case, which essentially are tweaking the numbers to say, what if we're wrong?
Yep.
We're either too negative or too positive. And that, while we don't invest for those scenarios, it informs our thinking very forcefully, and it gives us an idea of how wrong we could be in any scenario. So if you compare that to the inherent unpredictability of something like an ISIS, which is something, if I think we're all frank about it, no one in the markets really knew about ISIS 6 months ago, let's say. Compare it to the inherent unpredictability of those kind of events. We have greater confidence in our inputs, what we do with them, and what that means in terms of portfolio positioning than we would do in terms of these largely unquantifiable and definitely unpredictable portfolio risks.
Absolutely. And I guess the final point would be, we always say it, but diversification is a key.
Yeah, no, you're right. That's the one thing you should always aim to do as an investor is take on risks you're rewarded for.
Yep.
And any risks you're not rewarded for, get rid of it using diversification. Clearly that's part of efficient portfolio theory. It's not always possible, but what we can do when we're investing is make sure we're not too sensitive to any one factor. Don't put all of our eggs in one basket to sort of be colloquial about it. That's why you hold bonds in a portfolio even though they look expensive. You don't have many, but you have some there. It's an insurance policy, and likewise you don't always have a particular region's equity market. You want to have a broader spread of equity markets in your portfolio generally as well.
Absolutely. So something like ISIS, finally, presumably you came into the office, you looked at the portfolios again, and you went, yes, we are still happy with where we're invested as of today, given this new information.
Yeah, I think managing portfolios and the way we do it is a sort of an ongoing, it's an iterative process.
Yes.
Every day is an evolution rather than a sort of big revolution. On the whole, you get the occasional event which really sort of causes you to tear up the sort of the form book, if you like.
Yes.
But on the whole, you come in, new information. Is it baked into the price, yes or no, of different asset classes? If it is baked into the price, does it give us an opportunity to make a profitable trade for
Yes.
investors? But also, are we comfortable with the positioning and the amount of risks we're taking in our portfolio given this new information that's in the market?
Okay. So James, taking those kind of themes from the month, how then did that translate into performance for the Harmony funds?
Well, interesting. There are two main sources of asset allocation performance, if you like, we get in the Harmony funds. One is our regional allocation, and the others are sort of broad, top-down asset allocation, if you like. So let's start with the regional allocation. I've already alluded to this. The likes of the sterling funds, European funds, and the Australian dollar fund suffered as a consequence of their equity market coming off slightly in that period, and also strong currencies. So and this speaks to the global bit, where we've got global allocation in these funds, translating that portion back into your local reporting currency, your sterling or euros, for example. When those currencies are strong, it provides a headwind to performance. It makes that translation harder, if you like. Those assets have to run uphill, and that was sufficient to actually, again, be a sort of a negative influence on total returns over the month. But it's sort of it's a transitory thing to an extent. Currency, it does come and go. It's quite volatile, but crucially, the local markets drifting off didn't help returns there. The asset allocation decision then is the second part of the decision, which is relevant here. Particularly within the fixed income part of the fund, we've tried to add value over the last number of years actually by being underweight government debt, overweight credit, and on the whole that's been a very profitable position. Over a month like this, where government bonds drifted up from what is a pretty expensive position already, I'd argue, you didn't really get that benefit from being overweight credit. This is mainly because credit more or less kept up with government bonds, maybe outperformed by a handful of basis points, but it's not meaningful enough to give us a real differential there between the government debt and the credit market. So, roughly a neutral allocation, if you like, compared to our long-term asset allocation in the equity market with an overweight to emerging market equity. That did benefit actually over the month because those markets outperformed, the emerging markets outperformed developed markets. interesting, plotting their path year to date, emerging markets were substantially behind after the first quarter. This quarter, they've caught up. They're now pretty much the same return year to date. So it just goes to show how much emerging markets have caught up. Actually, and that's again, a valuable position in the portfolios. Then within the fixed income bit, again, not much to really report on, given the sort of the consistency of returns across the board. And then a detractor from performance over a month like June, where everything goes up. The cash holding in the portfolios, cash, as we know, returns are zero today, roughly. You've got positive returns from equities, positive returns from bonds. So while we think cash is a sensible long-term store of value in an environment where interest rates we think are going to go up sooner or later, in a month like this, it's a drag on performance.
Okay. So finally, looking forward now, you've got this cash potentially. What is your outlook, James? What are you expecting to see?
Well, we're at an interesting phase of the markets now. We think fixed income is expensive,
yes,
particularly the high quality bits seem very overvalued, but they're being kept at low levels because of two reasons. One, a lot of central bank buying activity of these securities, although it is diminishing arguably. Well, Japan's spending more, but US is spending less. And two, the market's still implying interest rate policy will be lower for longer.
Yes.
So these markets we think are expensive. Is there an obvious catalyst for them to sell off a lot in the short term? Probably not, but they're expensive. Equity markets, on the other hand, gone up a lot over the last 18 months. And interestingly, there's a lot of circumspection really surrounding it now. A lot of people are saying, has it gone too far? Are they expensive? Our view is they're not expensive for two reasons. One, just looking at the markets on their own, they don't look expensive in isolation. There's pockets that are expensive, unquestionably, but looking at the markets as a whole and looking at specific cheaper markets, there's definitely opportunities. And then particularly if you take it in the context of how expensive government bonds are, equity markets are actually quite attractive. So, we wouldn't necessarily be adding to risk today in any meaningful sense, but we want to keep risk on the table today whilst remaining diversified, as we've mentioned already. We've got a decent chunk of diversifying assets in the portfolio, but certainly we don't want to be running away from our equity positions today. Outlook-wise, we think that developed market economies are actually starting to stabilise, maybe look a bit more positive, and you can actually envisage a world where extraordinary stimulus is unwound on a sort of whole-scale basis, and interest rates at some point start going up. And again, that speaks bodes badly for our fixed income holdings, and would suggest again why we want to be holding cash in the portfolios today. So, in summary, reasonably positive. There's sufficient signs of circumspection in the markets for me to be positive that it's not in bubble territory, particularly in the equity markets. People are quite rational about it today. Having said that, M&A activity is picking up. That's sometimes a bad sign. And obviously the markets have come a long way in reasonably short order. Volatility is very low. We would expect volatility to pick up in that sort of environment. It's not particularly enjoyable in the short term, but it does provide us opportunities. And we've already talked about the patience required for multi-asset investing, asset allocating. That gives us an opportunity for a disciplined, patient process to take advantage of opportunities as they're presented.
James, I always like to throw a little bit of a curveball just at the end of these videos. A quick one-liner on Japan, if you could. What do you see in the Japanese equity market?
We're actually pretty positive on Japan as a whole. I mean, it's sold off year to date. It's made a lot of that back now. The last couple of months it's up nearly 10%. We still think there's good value there, despite what's happened this year, and obviously what happened last year was an excellent return. Japan was by far and away the standout developed market over the past 12 months, or to the year 2013. We still think there's good opportunity there. Abe's third arrow, the sort of structural reform, the market's largely priced in, a non-event there. We think there's an opportunity for that to actually work, and so we're reasonably bullish on Japan on a medium-term outlook.
Excellent stuff. James, thank you very much.
Thanks, Richard.